This is actually the last one that I'm going to be introducing. After this, I've got to run off and judge a coding competition. So if anyone after this wants to come see that, it's at 3:30 at the town stage. But for now, I will be talking about tokenization and how we can do it in a ethical way. We will be joined by our main moderator, Wick from Incite Consulting. And I'm looking forward to everyone having a great end of the day. Thank you for listening to me, and handing over to someone else now. Thank you.
Hi, thank you everyone for coming. I'm very excited to be with some really impressive subject matter experts. I promise it won't be as technical as quantum computing, but I think it will be really exciting as we're going to talk about something that I'm really passionate about, which is responsible innovation and more specifically responsible tokenization. So really quickly, I just want to let the panelists introduce themselves because they're amazing and I won't do them justice if I try to do it myself. So we'll start with Winston.
Hi, good afternoon everyone and welcome to the session. So my name is Winston Quek. I'm a CEO at SBI Digital Markets. Think of us as a blockchain agnostic tokenization platform that delivers investment products, curate, distribute and custodize. SBI Digital Markets is a subsidiary of SBI Holdings, a Japanese financial conglomerate.
Kenneth?
Welcome everyone. Thanks for taking time to be with us this Friday afternoon on the last day, right, of SFF. I'm Kenneth. Right, I'm a senior partner with the Singapore office of global law firm Dentons. Right, I actually started the Dentons Singapore's digital asset and DLT practice back in 2017. A practice we are presently co-lead. And Dentons Singapore, we also hold council membership, right, with enterprise. Ledger Hashgraph, right, where we, alongside other council members such as IBM, Google, right, and Boeing, we actually run validator nodes, right, and are constantly looking at innovation and looking at enterprise use cases for rollout.
Emily?
Hi, I'm Emily Parker, Executive Director of Global Content at CoinDesk. Before CoinDesk, I did a lot of other things. I worked at the U.S. government, at the State Department on technology and internet freedom, worked at several startups. I co-founded Longhash, which is an Asia-based startup, and happy to be here.
Hi, my name is Darius. I'm the founder of QCP Capital. QCP Capital is a digital asset trading company, one of the first in Singapore. We help clients with institutional trading solutions and trading strategies. And we are one of the largest market makers for crypto options and derivatives globally. And we are also shareholders of a lot of key trading venues such as Deribit, Paradigm in the digital asset space.
So a little bit about me real quick because it's relevant. Prior to Incite, I spent nearly a decade as a federal prosecutor for the U.S. Department of Justice. And after that, I was the chief of legal affairs at a blockchain analytics company called Chainalysis. And as a result, I'm incredibly passionate about innovating responsibly. I was joking with Darius before this. We were here a year ago on a panel together, and times were very different last year at SFF when we were all excited about institutional adoption and what the future would bring. And then a month later, FTX happened and ruined everybody's world. And our landscape now looks very, very different. So now the topic of tokenization, especially responsible tokenization, is even more important because we just lived through the ramifications of irresponsible behavior and the impact that it has on the industry. So I do want to front and say we'll take some questions at the end. So if you have them, please be thinking about them and we'll save some time for that. But I do want to jump right in. Kenneth, as the other lawyer, although I call myself a recovering lawyer, I think you're still lawyering, but as a lawyer, I'd love for you to just talk about how important regs and governance are in this space, and especially for the difference between unregulated and regulated assets.
I'll say regulation is getting a lot more important, right? Borrowing a tagline from the movie Spider-Man, with great power comes great responsibility. Likewise, with great adoption, right, there is a lot more responsibility for every ecosystem participant as well, right? And all the stakeholders within the ecosystem, right? And of course, I mean, for Dentons, I mean, we have been involved in like blockchain advisory, tokenization, right? Again, in the early days. Myself, I mean, my background is a capital markets lawyer, right? Although I do hold fintech credentials now, right? But the reality is that distribution of capital markets products in the regulated space, there are very established regulations around it, right? And I don't see that much different whether it's in tokenized or non-tokenized form, right? But what we do need to acknowledge is that if we are distributing a tokenized regulated capital market product, the existing friction, the existing restrictions is actually going to apply, right? I'm not saying that these restrictions are no good, but these restrictions, they compared to distribution or secondary trading of unregulated capital market products is actually very different, right? And it's going to be a bit less inclusive. I mean, let me illustrate. Today, if I want to issue and distribute primary distribution, right, of a regulated capital market product, in most jurisdictions, if I'm reaching out to retail, I'm going to need to file a prospectus, right? And assuming that the regulators are ready, right, to accept filing of a public offer document of a tokenized security, right, even that is still going to be quite a task. And for startups who are looking to innovate, this registration process actually comes at a cost, right? And even when which is why currently now, again, even it's fair to say, even in Singapore, right, a lot of the tokenization, regulated tokenization platforms, access is actually restricted to accredited investors. Now, why? Because when you distribute regulated securities to accredited investors, the benchmark is actually lower, right? And it also means that when it comes to secondary trading, there is a limited forum. Whereas if we look at unregulated markets, right, there is a lot more room for outreach as well as inclusiveness, right? But of course, the downside of unregulated markets is that in the absence of regulation, there is, of course, more propensity, I guess, for bad actors to come into the space or less responsible actions, right? And of course, if I say my own hope of the space is this, right? Not to maybe a balance between regulation and innovation my thinking is this. Quite often you may heard the phrase, if it walks like a duck, talk like the duck, you should regulate it like a duck, right? But I'm hopeful that regulators will also acknowledge that in this space where we are out to innovate, right, there is a new species of duck, right, that has come into the ecosystem, right? And further born out of the evolution of innovation, right? Or otherwise, there is a new species. And I'm hopeful that there's acknowledgement of that to give some leeway, right, for this new species of duck, right, to actually have a walkabout. But what's very important then, although that this new species of duck, I'm hopeful, should be self-respecting, behave itself well, perhaps even consider adopting self-governance, self-regulation, right? Even, as an example, I mean, even if you're looking at regulated products market, disclosures of offerings, you may, even if you're unregulated, you're not mandatory for you to do that, but there's no reason why you can't adopt, right, what is there in order to have more transparency, right, and accountability to whoever's willing to adopt your unregulated product.
There were so many analogies in there that I loved every word of it. I also love that you managed to get in a Marvel reference, so now we're 2 for 2 if you've been tracking the panel references. And something that you said in there that I think is really important, when I was in the government and I was kind of watching the industry, I think one of the frustrating things was it felt like not enough companies were asking, what should we do versus what could we do? And I think that's been part of the maturation stage, is watching more companies talk about that, which I think ties into something really, really critical, which is suitability. And, Winston, I'm hoping that you can talk about that, because I think what we're doing is, and who we're doing it for, matters. So can you talk about that in terms of how do you balance, tokenization versus some of the goals of, say, democratization?
Yeah, sure. Let's take a couple of steps back in history, right? So think about the last 10 years when interest rates were really rock bottom. The average consumer were trying to get the best of investment tools, squeezing out yields and so forth. Tokenization comes about in 2015 and opens up this opportunity to democratize, right, and allow essentially the man on the street to own almost anything, right? Private equity, private deals, real estate, a barrel of whiskey, sports car, you name it, right? It's all been done. Now, I think the traditional financial system over decades, through black swan events and systemic risk, have put in measures to protect consumers when there's a very ugly event. So when interest rates are low, people want to chase yields. A lot of innovation was put in place. Let's fast forward the next 5-7 years where rates possibly stay high, inflation is high. It's going to bring about a different scenario. Starting to see cracks in certain asset classes. Now, I'm just wondering, when people have bought those private equity deals that lock up 5 years, 1+1, how is that going to be suitable for them in a black swan event? So that's something I think we have to think carefully, tokenize carefully, and distribute to the right client base, right?
Well, let me follow up on that with a slightly spicy question, which is, do we even need a lot of the tokenization that has happened? How are companies handling that? And are companies even asking that question before they're tokenizing things? To be clear, I do think we need the tokenization of whiskey.
Sure.
That should be allowed. But everything else, do we really need the tokenization of everything?
Very good question. So when clients approach SBI Digital Markets, hey, I'm looking to tokenize this asset class. Our first question is, why are you doing this, right? It's very important. Private equity in small pieces, fund product in small pieces, bonds, it's all been done before, right? Tokenization and DLT actually brings about a processing, settlement, and distribution platform that has less friction. It's not always about the product. So I agree with you. Yes, in certain use cases, where there are complexities and intermediaries in product, it could be necessary. It has to be then on-sold to clients that are suitable and qualified to purchase these products. I think being a financial institution, that responsibility also lies with us.
Well, and let me just broaden it out for a minute, because we do tend to talk about the whiskey and the assets. But Emily, I know we talked about, we don't talk a lot about the broader categories of digital assets. And when it comes to stablecoins, CBDCs, do we need to have the conversation about responsibility and tokenization there?
Yeah, sure. I'm glad you asked that. And it's not just, and then even broader, I mean, like the original cryptocurrencies, Bitcoin, Ethereum, like where are they in this conversation? And I feel like we can't leave them out of this conversation. This entire conference is very focused on, asset tokenization, which is really important and has a lot of exciting aspects of it. But I do think we also we can't just ignore the sort of elephant in the room, right? And I think what's happened in the past few years, with FTX and a lot of these very high profile scandals is that a lot of businesses, governments, even investors are turning away from cryptocurrency and turning towards this idea of tokenization or stablecoins or central bank digital currencies. And that's fine, but I do think, personally, the original ideals on which, decentralized cryptocurrencies are built are still worth protecting, even if, some things have gone wrong, right? I mean, if you look at Bitcoin and why it was invented, it was to be a decentralized kind of cryptocurrency that was independent of banks and governments. And I still think there's something about that that's worth protecting, right? Even if things don't always go so well. And so when you talk about asset tokenization, is there a place for it? Absolutely. But again, if Bitcoin was invented to be independent of banks, a lot of the asset tokenization that we're talking about goes through the banks. You know what I mean? We can't sort of ignore that. And I just kind of feel like, I just hope we can have a world where all of these things exist. Central bank digital currencies, again, I think there's a lot of controversy about it, especially in the United States. It's actually, I would say it's almost hysterical in the United States because people see it as like a surveillance mechanism. But anyway, I think that central bank digital currencies, at least on the retail end, might not be as privacy protecting as they could be. Stable coins are issued by big private companies. So anyway, my point is just that I hope we can broaden this conversation to include all of these things and not kind of have one replace the other.
I will say it is frustrating because I am also the founder and CEO of an association for women in cryptocurrency, and the number of people who said, well, do you think you could change the name? Because crypto right now really has an issue. I was like, crypto has a PR problem, but everything that we're talking about is still based on cryptography. It's still this denial and this kind of almost like whitewashing to call it digital assets.
Yeah.
It feels like it's really meant to just make TradFi people more comfortable with what's happening in their lives, which that's fine. But I do think you're right that we really have to kind of be honest about what's happening. But I want to go back to something that Winston touched on, which was fundamentally the benefit of this, the increase in efficiencies. And Darius, I think this is something that you're really the good person to talk to. Can we talk about just, yes, clearance, settlement, all of the increased efficiencies? Where is the space for responsible tokenization there? And can you talk about that a bit?
Yeah, sure. Maybe let me even broaden the conversation a little bit because, like you said, comparing from last year to this year when we are here, I think last year when we were here, the narrative in crypto was how do we make everything crypto? How do we make everything digital assets? And of course, the champion for this was FTX, which they wanted to take every other asset class and make FTX the main trading venue for it, and tokenize everything and make sure there's a main pool of liquidity. I think from then to now, the narrative is now more what does the crypto world offer to the rest of the world? And specifically for us, what does the crypto world offer to the rest of capital markets? And I think, I've been in conversation with guys like Kenneth for the last 6 years, right, where there's always this crypto native world conversation, and then there's a separate parallel conversation about STOs and security tokens. Like this is almost like the ugly cousin of crypto, right? The STO tract, and there's becoming a bit of a prettier cousin, given all the bad PR in crypto. But I think we need to identify two narratives here. One is that like Emily pointed out, there is the narrative of crypto assets becoming more mainstream. I mean that's the reason why the Bitcoin spot ETF is so big, because you are allowing access to crypto native assets. But there's also the conversation about what, like I mentioned, what does the crypto world offer to the rest of the world in capital markets perspective. And I think it's not about the native assets per se, but it's the way crypto assets are being traded in a tokenized manner, like Amanda hinted at. I'll give a real example here to make it clear. Let's talk about crypto options. We trade that, and we are market makers there. We trade crypto options on the CME, and we trade, which is a traditional asset venue, and it's traditional settlement, and we trade them on exchange like Deribit. The margin and collateral costs of Deribit are 1/3 that of CME, and one of the biggest reasons for that is the way it's being settled. Not about the asset class. We're talking about the same instruments, same things being traded, just the way that's being settled. Deribit is settling it in a tokenized manner, meaning that it's constantly being settled. No T+1, no weekends. It's just constantly being settled, 4-hour cycles, versus CME, which is being settled T+1, and that's the traditional way of settling things. And over the weekends there's no settlement and all. And so because of that, they need to account for the risks of delayed settlement, and the cost trickles down to the user, right? So the question capital markets players and venues are having, what can they learn from crypto? Not about trading crypto assets specifically or tokenized assets, but how do we trade what we already trade, but settle it the way tokenized assets are being settled. And I think that's where the convergence is going to happen, and that's where it's interesting, where we're no longer distinguishing crypto assets, non-crypto assets, tokenized, non-tokenized. It's the same thing. It's just the way we're doing it. That to me is the disruptive power of it. I think there is a big danger in talking about this as a separate tract, where you say, okay, this is a specific asset class, maybe a fund or a commodity, and that's being traded as it is, and then we tokenize a little pocket of it, and then trade that separately. Because the fragmentation of liquidity from a capital markets perspective is dangerous. I'll give a real example of this year as well. You saw US dollars, USDC, facing a DPEG. Fundamentally, it's the same product, right? It's US dollars. US dollars are valued as US dollars, but you have US dollars that are digitized trading at 80% of the value of US dollars that are US dollars, right? So I think there's this danger of fragmentizing liquidity. I think as we tokenize assets, fungibility is very important, liquidity is very important, and that's where the regulator comes in, right? The question about CBDCs, if you tokenize the Sing dollar, is the liquidity on the digital Sing dollar the same as the liquidity on Sing dollar itself? If you tokenize gold, is the liquidity the same? Do you break up the liquidity, or do you enable the liquidity to be even better, meaning that there's a distribution channel that's more democratic, but the fungibility is there, and therefore everybody benefits. So these are some nuances that we need to tackle as we move along in tokenizing assets.
So I'm hearing you say same, but different.
Exactly.
Okay. Emily, did you want to add something?
Yeah, I just wanted to, I think those are great comments, and also just something that Winston said. I think at the end of the day, it all comes down to use cases, right? And I think one of the crises that cryptocurrency is facing, again, I can speak specifically about the United States, is that regulators, people in Congress, they don't see the use case for it. They're like, why does this exist? And if they don't see the use case for it, all they see again are the sort of like fraud elements, and it gets a very negative picture. And so I think when we're moving into this like new frontier of asset tokenization, once you leave this expo, I don't think a lot of people know what tokenized bank accounts are, And so I don't think the fundamental point here is to explain what it is. It's to like actually have people use it, because if not, you get into this whole thing where it's like tokenization for the sake of tokenization and just more industry jargon, and then just getting into the same cycle that we're already in.
Kenneth, did you want to add something?
Actually, I can't agree more with what Darius has shared. Indeed, we are looking at convergence, right? And that is how we use the technology that crypto has brought, that crypto funding has brought, that has built the infrastructure for now the traditional markets to actually leverage on that technology. I'll give you an example. For the longest time, the term smart contract has been coined for a while, right? Of course, there's also enough literature wrapped around it to know that the smart contract is not actually a legal contract, right? But it is a tool, right, that facilitates even the legal process of enforcement, right? So using Darius' example of derivatives trading, right? We have seen platforms, derivatives trading platform, where the collateral, right, that is frequently required, right, to cover a position for a derivative position is actually on-chain, right? And that actually itself facilitates settlement, right? So that reduces your likelihood of default risk as well, right? And we see that coming to even traditional M&A transactions as well, where it is actually possible for us to digitally, let's say, escrow, right, perhaps a payment amount, right, for a contract. Yeah.
Just to expand a little bit about the subject of liquidity that Darius brought up, far too often we hear a product being originated and distributed, and somehow magically, if you cut it down into small enough pieces, you're going to create liquidity, right? So liquidity, if you buy a private equity product, it's not liquid. Tokenization is not magic, right? It's just an enabler, it's tech. So this notion of cutting up product into small enough pieces so that you can then suddenly trade it, the trading will happen. It's only one-sided when the market goes pear-shaped, when everybody wants to get out a very small window. So I think in terms of being responsible, when we originate product, we need to represent the product clearly, because in a black swan event, people could lose life savings, right? This is not there's no games here, right?
Yeah, and I want to go back to something I think that Darius mentioned, which was the kind of tokenization of the creation of that some sovereign states are basically making stable coins. They're considering CBDCs. There's some of them I think are even considering tokenizing entire capital markets, and that seems like a really big deal. The ramifications of that. Can you talk a little bit about that, because it seems that there's a lot in terms of the what could we do versus what should we do, and what should governments do, and what are you seeing? Who are the forward movers there?
Yeah, I think this is a very important topic, because we've seen the consequences of a private player trying to take over the world without the backing of the government, or without the backing of the regulator. I think for us to move forward in a tokenized world, it needs to be hand in hand with the regulator, like Kenneth mentioned, like you mentioned. It cannot be a unilateral effort. So, I think it needs to be something, and in our conversations with regulators, with sovereign-backed projects, they always ask us a question: how do we get this critical adoption? And the answer really is to lend the credit for the regulator or the sovereign to lend the credibility that they have. And it's very important that you have that, because that kickstarts this whole virtuous cycle of credibility and trust. So that's very important, and there are a couple of sovereigns that are very progressive in this. Singapore is one, of course, with the various projects and partnerships with with private industry players. The Middle East has a couple as well, Abu Dhabi specifically. Hong Kong has been interesting as well. So the US, of course, very complicated. There's things going on, but there's a lot of nuances there. But I think the world is moving in the right direction. And I would say with regards to this, just an example of the importance of CBDCs, and this is an example that's not recent, right? It's an example that is probably 6-7 years old. Like Emily mentioned, you come here, you poke a couple of screens, and you're figuring out, you might forget what the use of all this is. I think for us, it's a very fundamental use case because, as people on the ground who are actually trading stable coins, we see how useful it is. Just to give an example, that people, companies or small businesses in countries where currencies are restricted, it's difficult for them to do settlements offshore. It's multi-currency through the banks. There's a lot of friction on many levels. The use of a stable coin turns a 3-day-long process that costs 1% to a 5-minute process that costs 5 basis points, 10 basis points. So the use cases are very, very real, and it's not just theoretical. And this is just a very simple use case that's many years old, and right now there are more sophisticated use cases in the banks and the settlements. So I would say that the utility is very real. We're starting to see more convergence, like Kenneth mentioned, and seeing more big industry players and institutions using these benefits. And I'm very hopeful that the next few years we start to see more widespread and mainstream use of it, and there's a lot more trust as well.
Yeah, I will say, I think that's one of the problems we have in the United States, and I know Emily and I have talked about this, is that remittances, cross-border payments is such an unquestionably obvious use case, but that's hard to explain to a lot of old white dudes who have probably never sent very much money abroad. They don't understand cross-border payments. They certainly don't understand remittances. But meanwhile, every time I get a cab or an Uber in the United States, I've got a crypto convert in 5 minutes, because they're sending remittances, and it's a $1 trillion industry.
And also, just to add to that, I think generally speaking, there's, in the United States among Americans, there's basic faith in the U.S. dollar, basically, right? I mean, it's not, there's not like, yes, we're dealing with inflation, but if you're in a country, for example, with hyperinflation or, strong devaluation of the currency, then stablecoins take on a totally new urgency that we just don't have in the U.S., so.
I would debate that, and I would say the United States eliminated financial literacy in the 70s, so whether it's a knowledge of the dollar or blissful ignorance, we could debate that on a whole other panel. But I do think, going back to something that Darius said that is really important, is the relationship with regulators. And I think, I was at FinCEN for a little bit in the United States, and we used to have these innovation hours, and that was great. But if you look overall at the U.S., it's actually really frustrating how little regulators are working with industry. They've had a predilection for suing them, as opposed to conversing with them. And there are so many other jurisdictions that are just on the opposite end of the spectrum. And I guess I would ask all of you, if you were in a room with a regulator and you were giving them advice because they have obviously a mandate, right? I think Winston's point earlier, they are trying to put up rails to protect consumers while also hopefully allowing this innovation to thrive, which is tricky. But as they're trying to thread that needle, if you were in a room with a regulator, what advice would you give them? Because I think for me, having been in the government, the industry's failing for the last several years was not giving very good advice to regulators. And in the United States, the mantra was don't regulate us. So if you were in there, what would you say and how would you help them?
Maybe I'll take a stab at this one, right? So we have recently just completed a project with the MAS called Project Guardian. In Project Guardian Phase 2, we had the JFSA, FINMA, and AMAS, and we did basically a securities, buy-sell from Switzerland to Singapore, and we report the trade into Japan. To really ask for advice is probably not the way. I think guidance is probably better, and I think what Darius alluded to earlier on was sort of like, for them to basically supervise, right? And through observation of last year's Project Guardian, where we issued a stable yen and another counterparty issued a stable Sing, that deal was successful, and hence we had other regulators joining, right? And then with their confidence behind and backing these deals, we are able to now basically put in motion a framework that will allow us to commercialize what we've been thinking of. So I think a collaboration is important, seeking their advice and, just to give the whole deal credibility and confidence. But I think to sort of ask, to tell them what to do, I think the regulators prefer the private sector to be leading, right?
No, I 100% agree. And I will say, I think that when you look at BRICS and some of the other projects, the collaboration that you see between other countries from a monetary policy perspective, I don't think we've seen anything like it. I have my own personal theories about how it could impact de-dollarization, but again, whole nother panel, whole nother topic. But Emily, I'll turn to you. If you were in the room with them, what are you saying? How are we helping?
Yeah, so I am often in the room with them giving them unsolicited advice, So I think it depends on which country you're talking about. I mean, obviously I think Singapore, gets it. That's pretty clear. Japan is a really interesting case. I spent a lot of time in Japan. Japan is also like a real leader in crypto regulation. But it's interesting why they became a leader in crypto regulation. They became a leader in crypto regulation because they had really bad things happen. The first one was the hack of Mt. Gox. The second was the hack of CoinDesk, another major Japanese exchange. And so the regulators put in some very strict rules basically to prevent that from happening again. So I guess the argument that I would make in a country like the U.S., which is not particularly leading in regulation, is, look, there's crypto people out there making these very idealistic arguments. I don't think it really resonates with regulators. I don't think they want to hear, like, crypto is the future of freedom or whatever. I think the argument I would make would be about customer protection. And that's basically sort of what the Japanese learned. It's like, look, crypto's not going anywhere. It's already here. And just by sort of not having it regulated within the U.S., you're actually exposing customers to greater danger because they're more likely to go to offshore exchanges that are just basically offer you no protection at all. And that's kind of what we saw. The irony is that FTX really wanted to be regulated in the United States, didn't manage to do it. And so people who invested in FTX kind of lost everything. So yeah, I would make an argument kind of along those lines.
Fun fact though, nobody actually focuses on the fact that thanks to crypto's the ability to see it on the blockchain, they've recovered something like 80 or 90% in the bankruptcy proceeding, which likely would not have happened with cash. Everybody loves to crap on crypto and never talk about the benefits. Side note, sorry. But Kenneth, you want to add something to Emily?
Just a quick addition. Yes, regulation is good for lawyers, right? Earn more fees, but I love innovation better, and I would say do a light touch, right? There are existing frameworks that are protective, right, of ecosystem participants. If we look at a lot of the meltdown of crypto in recent times, actually a lot of the losses actually occurred not in the primary, not in the product itself, but actually more in the secondary markets, right? So is it possible, for example, to import insider trading regulations for it to apply, right, to the token markets, right, without actually classifying the token itself as a security? Right? That would be protective of the secondary markets. But frankly, beyond regulators, I think we need the buy-in. If we are looking at broad-based tokenization, we need the stakeholders who currently control all the centralized asset registries as well to actually participate. If you look at carbon credits, for example, we had conversation, we had use cases in the Hedera ecosystem, for example, that says we want to tokenize, but the stakeholder, the central registry are usually slower to move, but so we start out responsibly, right? We just tokenize one segment of it. You want to tokenize the property? Don't tokenize that property with a freehold title. Carve out 7 years of leasehold title, and we just tokenize that. If it fails in 7 years' time, the title comes back to you.
All right, well, I want to leave some time for questions, but Darius, last word. You're in the room with the regulators. You're a market maker. How are we helping?
I'm going to give a more sort of selfish answer here, and from our perspective as a capital market operator, I think the difficulty with this topic is that a lot of regulators approach digital assets like a weird alien baby. They see it as this strange thing, not sure what it is, potentially dangerous, and has proved to be a little dangerous as well. My request is that they treat digital assets and crypto like they treat any other capital market asset, right? I think that for us is the win. Not to treat it as something completely separate, to be separated separately from the rest of the capital market, but to include it in capital market regulations. Of course, there are going to be nuances, as is with any asset class, and the nature of the asset class, but to just have the same rules and the same playing field, and to treat it very normally. I think that's really the request, and I think that would solve a lot of issues.
I will say that's a really good note to end on. As a former prosecutor, I have found nothing more frustrating than banking suddenly caring about scams because it's in crypto. And I frequently say to them, for a decade, I tried to get you to care about elderly fraud and all of the things that were happening when it was going through your bank. But now that it's crypto, banks really care about scams and fraud. And I'm really glad they're here for it. But there's something about crypto that they want to pretend it's different. But to go back to the very beginning when Kenneth, I think, won the analogy game with if it walks like a duck and talks like a duck, let's just keep treating it like a duck, I think is a really good point. I do want to leave some time for questions. Does anyone in the audience have a question? You've got really brilliant minds to my right, so it's a good time to ask them a question. Not one. I think you guys literally answered everything there was to answer about responsible tokenization. Well, if the Elevandi folks aren't going to get angry, do you guys mind if we end a little early? Because we've covered everything there is to cover, and there's literally no question.
It's all sorted out.
I know, it's all sorted. We've solved the problem of responsible tokenization. If there's any regulators out there, you're welcome, I guess. I just want to say thank you to the panelists. They are really, really brilliant people who spent a lot of time teaching me about this and sharing their knowledge. So thank you for coming. And if you have questions and you just didn't want to ask them publicly, they'll be around to the right afterwards. Thanks, guys.
Thank you. Thank you very much. Thanks, everyone.